What's going on, everybody? Welcome back. Today is going to be our first introduction for the first presentation gap, model number one. It's going to incorporate model one and technically model two because I'm going to go over two different targets that we're going to use for it. And the reason that they both could kind of blend into one is because this is going to be everything minor. So this is close inefficiencies. This is targeting close minor buy side, sell side liquidity in the morning. So there's a benefit to using this, and you could tell it's kind of favored more towards scalping. So you'll see as we go through this whole series, and there's going to be many models. There's probably going to be roughly 4 to 5, all on first presentation, and where you're looking to target to. And you have to find which one speaks to you, which one you like the most. And I'm going to show you guys how to properly document and keep a track record and a nice file of data that you're going to build evidence on and get more confidence and comfortable around these situations. So we're going to get right into it. We're going to try and keep these pretty short. So I'm going to just jump right into it. So if you guys could bear with me here, I'm going to start on a 15-minute time frame. So this model includes, we'll type it out as we're going. So everything should be in a sequential order when you're obviously building a model, right? So the first step is going to be minute 15 or minute 5. Okay. It's minute 15 or minute 5 inefficiencies. Okay. So you're going to look at the current range you're in. So this predominantly works when there's a large movement or you're going to 9:30 and there was a nice little landslide or a quick, you know, push higher right before maybe 9 a.m. going into 9:30, right? And you're going to see us reverse back inside that range. So I'm looking for minute 15 and minute 5 inefficiencies. I'm then looking for the minor buy side and sell side. You never have to demand the buy side or sell side when you're targeting and scalping for inefficiencies. It'll be like a stop loss to break even, partial off, and then if it gets to your target, it does. If not, there's no harm in attempting it. I'm not here to say I know every time it's going to run liquidity versus inefficiencies. I just know that if it's going to run for the liquidity, it's going to run for the inefficiency first, right? That's common knowledge about how things are stacked in the whole PD array matrix that ICT's taught. And by the way, this is his method. I'm just showing you how I'm using first presentation as a model and how it really kind of clicked for me in terms of finding those nice one-way order flow setups and being able to pull a portion out of the market for myself. So, like I said, we start on a minute 15, minute 5, and we look for any fair value gap, buy side liquidity, and sell side liquidity. From there, we need to wait for first presentation. Okay. And first presentation is the minute one fair value gap that ICT is taught. You guys could go on his channel and look at all of his in-depth findings, and his directions on how he uses it are definitely, more up to date, more accurate. The way I like to use it would be obviously as he taught after 9:30. It cannot be 9:30 on the dot because 9:29 wouldn't exist. And so 9:31 would be the earliest it could format. Once it happens, we are looking for nice one-way runs off that. No retracements, nothing, just a nice swift motion higher. Okay. And what that's going to look like is you're going to go on a lower time frame and see it now. You'll see we're going to graduate into one day being able to take first presentation gap all the way into previous week's higher low. Okay. And that's the whole goal, that you could work that whole hierarchy of targets and start off by just taking simple little things that happen almost every single day, and then graduating to say, okay, I only want to take 2 to 3 setups a week, but it might be, run to previous day's high or previous week's high or low, in that sort of nature. But you're going to get a little more, but you also have to be a little more caution and uh laid back waiting for your setup. It's not going to be there every day. So I'm going to jump right inside of a minute one. Okay. And you guys will see it'll already be presented. That is our first presentation. I just want to grab those rules and bring them in here. All right, so what I'm liking here, I like when we have our first presentation for value gap, and I'll share things that I use, things that I would avoid, things like that of nature. It doesn't mean it's correct. It's this is how I like to use it. This is what I see with it. So I like when we see a gap and it actually runs away from it a little bit and then comes back to it. Because what this does is if I'm looking for something like an inefficiency, right, which is above here, this is our inefficiency, this is the liquidity. I'll throw some tags on it just to get it dressed up a little bit. And I like how when it works underneath it, you have things like this going on. So if I'm looking to target, okay, where is the closest inefficiencies on the current price run? It's up in here. So obviously, I'm not looking for shorts. I want to scalp from here to here. I don't care if it wants to run here and drop down 1,000 handles. I'm looking from this price right to 22,243 flat, potentially 22,250 flat, and then an extreme would be 22,259.75, and you could always keep a runner and see how far it wants to stretch after that before it wants to retrace. So, like I said, I like how when it's like this, you could actually see price come back to it and nudge and work the lower half of it. And when it's doing that, you could sit back and relax a little bit because the ball's like in your court. You could say, okay, I need it to print an order block and I need it to trade above that and candle closes above that. And then I'll start looking at that area to be respected. And that's the beginning or the origin of your order flow, right? So if you look at this movement, we have this whole run lower, and I'm sure there's some liquidity over here to our left that, this ran through and stopped or an old inefficiency. But it ran. Look at the turning point, 942. That's a timed array. We'll be teaching those later on, but that's a timed the number. I had mentioned it, ones, twos, six, seven, eights, so on and so forth. Those are minutes in the hour. They're a little more sensitive. So I see this down close candle print, and then it flips. Okay, some people might like that break structure. I'm not huge into all that. I never got really too involved. I just like watching order flow from prices to prices. So I see this as a down close candle or block. This is the origin of my order flow here. So this is where it started. I want to see it now create a stacking effect just as it did. I don't want to see it start doing this, right? You want to see it take a one-way pass. Okay, this is order flow. You're expecting this is the start, and it should now want to go towards its desired direction. So when it starts breaking into the upper half is right in here, it comes back down, touches right back on the order block, and now we're getting good body closes all up in here. So you could view these as 1, 2 down close candles for an order block. Could have had an entry right around 50%, stop loss sat below that, and you could have been trying to scalp your way into this movement, taking it from here, first presentation gap, into an inefficiency. It's like a magnet. Look at it, go right to it, it wicks it, comes back down, drills right into the high, sits on the high, goes back and forth. And I do not believe this one ended up going for buy side right away. I think it came for a deeper dive. But it's just to show you how you have an inefficiency as a target. Once it hits this, stop loss could sit at break even. And then you could just keep trailing your stop loss up because, like I said, you want a one-way piece of price action. You don't want big retracements and then time distorting. You know how fast this thing could move. Look at this price run, right? That started at 910 and it was done at, 940. Quick little, burst of energy in there versus something like this could take the same amount of time and it just went sideways. So you want to get technical when you're looking for this. You don't want to settle for things. You should want it to move in your direction hard and just run completely away. So I'm going to share with you guys another little bit of evidence we have in here on the same model. And this is going to be on ES now. The reason I'm showing you it is because this works on all future pairs. I personally don't love the Dow Jones. I think sometimes it could be a little tricky to trade. It likes to go against ES and NQ a lot of times. Sometimes it's an indication, it's like an early indication it's running in a certain direction because it'll just start taking off while ES and NQ are a little bit slower. But that's for you guys to decide with your own study. So what I did here, same rules. We have minute 5 to minute 15 gaps. So the last one was on a minute 15. This one I'm showing you a minute 5. Here's your fair value gap. There's another inefficiency in here that got slowly nudged into, but I would take the highest one. And then you have buy side, right? This would be minor buy side. And then you have another inefficiency in here. So when we drop into a minute 1, you're going to see a few things in here. So that is our first presentation gap. Okay. And look at how it ran. And like I said, your current price run is where it's running lower. So it has to retrace back inside the range. It's not going to be, dropping even lower. If it's dropping lower, you're looking at, London highs and lows. You're looking at previous day's highs and lows. You wouldn't be looking at the current range to retrace back into. So this is like a footing to go fill an inefficiency before it could make its next movement. So what I'm watching in here is, do we have the ability, okay, when it opens, price is climbing above higher. I would have liked to see this as a nice down close candle. If we got a close above it, that would have been nice. It's not there. There's no gaps. There's just this one. If you had taken entries in here, you could call it a stop out. I'll be fair with that. We could, you know, play good. I like to use order flow as entries a lot of times. So like it's like running into it and it skips over it like this. But if you're going to enter just when it comes back up, your stop loss probably would have sat right about here in these wicks. Okay, because you're expecting it to take off. You want to see sensitivity here. Personally, once I saw this candle, if I was still in and then it traded higher like this, I would have bumped stop loss up to right there because I would have looked at this as a an order block. And you're also going into 10 a.m., so nice little sensitivity in there. Something else that we're tending to look at in here is when price runs from 949 and it goes straight up into. So when price runs from first presentation, look at how bodies close above. Okay, so if you got stopped down here, perfectly okay. Once again, look at that nice down close candle, your origin for the order flow. Price starts moving higher. It holds it. You have gaps, so stop loss would have been safe right here. You're watching stacking entries in here, and then you're looking to target our inefficiency. And we have a higher one, and I didn't include the liquidity, but it's right here. So there's a few levels. So you can see how these are nice little scalping levels. So if you're coming in, and this is not designed to, you could make this, your designated model that you want to use day in, day out. That's perfectly okay. I personally only use this when I find it's a harder day of trading where it's a little sloppier. I'll pick off inefficiencies and stuff. More so, I like to go for a little bigger targets, a little more stretched out ones, certain days of the week, which we'll get into in the next few models. But just getting into it, this is our first model of it. It's just, we'll just label it as model number 1 on first presentation. And as I stated, this is just simply a scalping model, right? You're taking it from one level to that. It's a direct line. And you'll notice too, there's going to be times, and I'll have to go back to the minute 1 to do this. When you get good at this, you're going to be able to use a fractalized aspect and concept that you can now go on a 15-second time frame chart and be looking at the order flow in there, getting much tighter entries and stop losses in there. So I'll show you an example. So first presentation gap is going to be that purple one. So what do you kind of notice in here when we were looking at it, right? So this is where we were saying price rallied up higher. We could have started taking entries in here. Stop loss would have sat there. But look at the 15-second, and you have to be more prone because you will take more stop outs if you do it this way. But when you get the entries, they're extremely precise. So when you're doing it like this, you are entering on this with stop loss very close to it. You would never enter on a 15-second in here and put your stop loss all the way down, right? You want to see it, like I said, that order flow. So notice the fair value gap in there overlapping. Great confluence in there, two down close candles. Stop loss could have sat right there. If you're a little more conservative, it could have been down there. That's not horrible. But right in here would have been solid. And now look at what that could offer. And you're really not even trying to see it break out of the bottom of the first presentation. It could wick. That's why you're moving your stop loss. If I saw a candle close below it, I would start shaving off some of my what I'm risking because that's not how I want to see it behave, right? You want to see a nice run. So look at how that becomes a 1 to 5, right? Versus, granted, if you were stuck staying just on the minute one, and say you got your entry right at 50%, your stop loss would have been right about in there for, let's see, a little over 1 to 2.5, which is still a great trade. I mean, you're grabbing 7 handles in ES, so that's great. You can't beat that. And look at how fast that is. See how it's like a magnet? Boom, boom, right to it. And like I said, this is just a scalping model. So we're going to go back to our other sheet where the rules were, and we're just going to finish that up. You guys will be able to check that out and then start back testing. So I would do this if it was me trying to journal this. I'm going to show you guys how to journal, and then we're going to close this one out. So I will label this as minute 15 fair value gap. And I would also I would have the time of this gap, so 9:35. And then I would label this as, I would put it in its own folder as first presentation into inefficiency slash minor buy side sell side. I would say this is Monday 2/17/25. And what I'm doing is I'm building a track record of days that this is happening on. Any specific days of the week is it more likely to form on? And then I'm also looking at the timing, right? So you guys could see at the bottom there's the time. So I want to see, does it happen earlier? Is my entry is it are a lot of times are the entries happening earlier, right around 10, before 10, after 10? Is it coming back to dip into it at 11 or 12? Those are all things you're going to start to notice. And like I say, you're going to start to build a log and you're going to have everything noted in there. So it goes minute 15, 5, fair value gap slash buy side, sell side liquidity. And we have to label that as minor, right? Because everything's going to be close here. You have first presentation, entry has to be inside. Okay. So your entry has to be inside of it. This needs to be technical here. You don't want it below it, don't want it above it, you want it inside of it. Right on that 50% line is best. Anywhere else inside of it is acceptable. Entry in first presentation. And then 4, you are going to be studying order flow. You're going to study one-way directional order flow. Okay, which is this. One swift motion. And what I would do is I would download this picture, take a screenshot of it, and I would log it just like that. And boom, it's filed away. And then when I'm going back through, I'm flipping through all of these pictures I have, and I'm just going, okay, yes, a lot of times it's happening here. I'm building a visual log of it. And then as I'm seeing it in real time, I'm like, okay, yeah, I could see this stuff. Here's the inefficiencies. These are up first. You'll notice even when we have things like, previous week's high, low, previous day's high, low that we're going to start targeting in models later down the road, these are still going to be checkpoints. So if you notice, like what ICT will do, and I like this a lot too as well, when I'm targeting those levels, I'll be taking, one off here. I'll be shaving one off here. And you'll notice that the times it does run for those levels, it'll even cruise right through these. It won't reject it and turn around, right? So when you see these things, you could get comfortable throwing stop loss to break even because you know that order flow is going to begin. You're on a much higher time frame, macro where it's moving. It's moving with great speed and velocity to get somewhere. So that being said, guys, I hope you guys enjoyed this. Definitely take notes on this. Go study it. Go look back for it. Minute 15, minute 5, find your inefficiency and look at how many times it runs in it. You have to look at your inefficiency after 7 a.m. And preferably, right, you have to think, look at 7, wherever it opens, and notice what 9:30 tends to go for. So it'll kind of rock one side or the other, and you want to see it flip. This is just like a news template where you like to see, the news release have an impulsive move one direction, and then the real movement is a mathematical doubled sequence or something lower or higher, and it's a one-way order flow. Sometimes it's slowed down, sometimes it's sped up, but that second part of the move is what you want, and it's in here, right? And it comes off of these levels. This is a safe spot to get an entry and trust that it shouldn't come back to it when it's actually going to work out. So that being said, guys, I hope you guys learned something. If you guys like this, please give us a thumbs up, subscribe, and we will keep pushing all these videos out. And I will show you guys many more of my models that I've created using ICT's concepts.